On the Spot with Michelle Makori is brought to you by Meld, the next generation decentralized global bank.
The U.S. banking sector is showing fresh signs of fragility. It's been a few months since we saw 3 of the 4 largest bank failures in U.S. history. In March, SVB and Signature banks collapsed, and then in May, First Republic failed, with the federal government overseeing the offloading of its assets to J.P. Chase. Since then, the Fed continued to put stress on the system, hiking rates another 2 times, and now more cracks are emerging. Moody's recently cut the credit ratings of 10 mid-sized and small U.S. banks and also put some of the nation's biggest lenders, like Bank of New York Mellon and State Street, on review for potential downgrades. And now analysts from Fitch Ratings are warning that a number of big banks, even J.P. Morgan, could be downgraded after Fitch cut its assessment of the banking industry's overall health in June. Now, the fact that Fitch lowered the score of the U.S. banking industry's so-called operating environment to AA- from AA went largely unnoticed. But now Fitch is saying that if this gets downgraded 1 notch lower to A+, the rating agency will have to issue downgrades of more than 70 U.S. banks. And also getting very little coverage is the marriage of necessity between PacWest Bank and Bank of California, with a merger of the two that will create a bank with $36 billion in assets. Meanwhile, on the other side of the pond, we have the messy UBS takeover of Credit Suisse, which was orchestrated by Swiss authorities. But now UBS is facing a growing number of legal challenges to that controversial takeover. Well, my next guest had warned earlier this year that there is a real danger that should the banking crisis worsen, there could be new regulation that would prevent people from withdrawing their money. That he could see the Federal Reserve or U.S. Treasury implementing a lock-in period and restricting depositors from pulling money out of their banks. Now, he has cautioned that history has shown us that dire times can lead to extreme measures, citing the Gold Reserve Act of 1934, when gold was confiscated and private ownership was illegal. Hugh Hendry is an investor and the founder of Eclectica Macro. His many correct calls include the gold bull market in 2003 and the U.S. housing crisis in 2008. And he is known for his outspoken and often contrarian views that are often backed by his willingness to take on very bold positions. Hugh, great to have you with us. Welcome to Kitco.
Heavens, I must meet this character. He sounds interesting.
Oh, he certainly is. And we are thrilled to have you joining us, or the AI version of you, whoever's with us today, coming to us from St. Bart's. Really great to have you. So, Hugh, I just went over some data points showing concern over the U.S. banking sector. Commercial real estate also a very big cause of concern here. And we're seeing more bankruptcies. S&P recorded 64 corporate bankruptcy filings in July of 2023. We've already seen more S&P bankruptcies in the 7 months of 2023 than the entire 2022. So corporations are feeling the pain of higher rates. And in the second quarter, U.S. banks also saw almost $19 billion worth of loan losses. That's the highest level in more than 3 years. And earlier this year, you said that Fed tightening will lead to some kind of breakage. And in an interview with Bloomberg back in May, at the height of the banking crisis, you said that things could get very bad and that it could be time to panic. Now, back then, you said, and I'm quoting you, "Sometimes it's relevant to panic, and I would recommend you panic." All right, so we're a few months on. Where are you on the panic scale? Are you panicking more? Are you panicking less? Are you recommending more or less panic? What is your assessment of the state of the U.S. banking sector?
I mean, obviously, I am a panic merchant. Why am I so panicky? I'm so panicky because no one understands money. You know, I jest. Do I jest? But I can think of no more than 5 people in this glorious world of ours that perhaps could make a stab at explaining the financial system and indeed, you know, this imponderable question about what is money. So I panic. And markets are all a game of pretense. You know, we don't know what's going to happen next. But with regard to the specifics, with regard to the banking sector, it's a it's a story, if you will, of two halves. There's good news and there's bad news. Okay. So the good news is that in the period late 2020 and all through 2021, the private sector in America, the household sector, let's start there, they refinanced their mortgages at incredibly low rates. And they fixed those low rates for the next 30 years. You know, they fixed your typical mortgage rate, refinanced in the middle of 2021. I want to say your mortgage rate would be less than 3%. Okay. So that's the good news, because we've had an unprecedented, large and rapid succession of rate hikes by the Federal Reserve. And I want to say that the household sector has been immunized. It hasn't felt the shock. Its disposable income, it has withstood the test, if you will. It has this big kind of barrier. So that's good, you know, and we see that the employment statistics and indeed the economy keeps ticking over. The bad news, however, is that a risk that has been transferred. What is that risk? The risk was changes in interest rates, okay? And in America, the household sector was able to transfer it to the capital markets and pretty much executed that in 2021. But a risk transferred is not a risk eliminated, okay? And so let's talk about the other side of the risk. The other side of the risk is that for the best part of 15 years, long-term interest rates have been remarkably low. And in real terms, we would say that they were either zero or negative. And the banking sector, it borrows short-term and it lends long. And so the financial sector in America has a gargantuan amount, trillions of dollars of debt that it lent to the household sector and to other economic agents at the wrong price. Yeah. Those loans now trade at a great discount. Okay. And that represents a loss of wealth to the shareholders in the United States financial sector. And it also represents a source of great anxiety for the lending officers for US financial companies. No one, if you will, has jobbing juice, is drinking the Kool-Aid and seeking to expand loans. And so there's a degree of, if you will, asphyxiation. The economy needs credit like the human body needs oxygen. And the combination of this gargantuan pile of loans made at the wrong price versus today's Fed funds rate, and then, as you said, the first incidence of stress that appeared in March of this year means that bank lending now is either flat or it's contracting. And so that would be an ominous indication of where economic growth is likely to go. Economic growth is likely to slow down.
But I get your point that risk transferred is certainly not risk eliminated. Where are we in terms of the riskiness of further bank collapses? Earlier this year, as I said, we had 3 of the 4 largest US bank failures in history, and it looked like there was a time where we would see more dominoes start to fall. Is that risk subsided somewhat, or do you still think that the banking sector is in a situation of peril, of impending crisis?
It is a situation of great uncertainty, and with uncertainty comes this loaded notion of peril. But yeah, so in this world of 24/7 television and reportage, we become childlike in our fascination. I have 3 children. Once upon a time they were young, and once upon a time we planted seeds in the garden. And every morning we'd come and we'd put water on those seeds. And I would promise the children that a beautiful plant would emerge. And after 2 weeks, the children went, nah, you're making it up. And investors, I'm afraid, are a little bit like that. It takes an enormous amount of time for the United States economy to change the course of its direction. It's a $25 trillion entity, okay? And what do? I pursue this dismal science of peering into the future. I have this sometimes, because I'm a little bit unhinged, sometimes I get the merest sense of what is about to befall us. But when I'm putting on trades, I'm putting on trades with the certainty that I don't know when it's going to happen. Mm-hmm. And I usually exercise a series of strategies whereby I've got 2 years to be proven correct or wrong. Okay. And this is a 2-year operation which began this year. And so for me, between really from the beginning of this year until the end of next year, I would say, to use your word, peril, there is great peril and uncertainty. The uncertainty being that actually the economy could slow down rather dramatically, and that the provision for credit and impairment costs within the financial sector could escalate, and the valuation of banking stocks and other financial stocks could correct. I mean, JP Morgan today, clearly a best-in-class entity, as everyone tells me. The people who wear suits, they tell me it's a great bank. Okay. Well, you know, it has a market capitalization of near $450 billion. It has shareholder funds of like 290. And if we get peril, those two figures will come closer together. Typically in a recession, you do see that even the best banking franchises are pulled towards their net asset value, their shareholder funds. So I would say my presumption is there is significant price risk in the financial sector, and indeed in the overall stock market globally.
Right. And certainly a valid point that it takes time for these scenarios to play out. And it's very hard to predict the exact time that these things will unfold. But sticking with that peril and panic theme, because you made huge headlines after that interview with Bloomberg and others, where at the time you said that you thought it was a very real and very scary possibility that the Federal Reserve and the US Treasury could put a lock on US bank deposits, essentially saying that people couldn't pull their money out for a period of time, say 180 days. And you cited quite rightly that this has happened before. You cited the Gold Reserve Act of 1934, where at the time gold ownership was banned and US citizens were forced to sell their gold below market value. So we know that dire times call for extreme measures. I get that this all takes time to play out and we're not there yet, and hopefully we will never be. But do you see this scenario that you thought of then, where there is a lockup period for banks, as more likely now or less likely?
Well, I would assign the same probability. So back then, in April or so of this year, I was trying to address the notion of probabilities. So we had an observation, as you say, the Federal Reserve Act of 1933. And it was necessary because the entire US financial system at that point was bankrupt. And the citizens of America knew that. They were cognizant of the credit risk of their deposits, and they were seeking to transfer their paper money and transfer it into gold. And the Federal Reserve made it a crime. You could not own gold. So that was the observation, okay? And that came as a result of the 1920s and a whole set of economic policies, which culminated in the Great Crash of 29 and the bankruptcy. The relevancy today is that the economic system of the last 10, 15 years, I would argue, has parallels, that America is very much co-joined and is the center of the global financial system, that the whole system is financed from using the collateral of US treasuries. And in the last 2.5 years, we have seen a 3 standard deviation event, which is to say something very, very rare has happened. And that the price of US government collateral, I don't want to say it's collapsed, but the price of long dated US government bonds has fallen it's halved. is halved, right? All of the gains of all of the price gains in US treasuries for 15 years have been wiped out, okay? And that has implications for the entirety of credit creation and economic growth globally. And what are we seeing? We're seeing Europe, we're seeing producer prices now are firmly deflationary. In China, consumer prices are deflationary. All of the economic surveys, manufacturing data are all pointing to great concern that this could coalesce into another episode similar to 2008, where we have a synchronized global economic downturn. Now, when that happens, so when it happened in 2008, the financial sector gets hit and its viability comes calling into question. And so I was saying that previously you would have assigned a probability of being gated in a bank like a black swan, perhaps. I mean, black swan is overused as a metaphor, but maybe it would be a 0.2% chance, like a very low probability. And what I was saying back then was like, I kind of foresee it as being a 5% probability, like a 1 in 20. And it has parallels with, if you will, the perception of conflict between the United States and Taiwan. If we dial the clock back 5 years ago, again, at most, experts would have said 0.2, but now 5%. And all I'm trying to offer people is the notion that one has to be curious, one has to be cognizant of what has happened with great economic and global drama in the past, so that we can be wise and assign probabilities to events such as a gating in the banking community of the United States.
Right, fair enough. So right now you're saying there's a 5% probability that this kind of action should be taken. And to your point, we've had a lot of once in a lifetime, or not even once in a lifetime, once in 100 years events happen in a very short period of time, not just 2008, obviously the COVID crisis. We've had situations unfolding that we couldn't dream of happening before. So very important to have these things on the radar. And, Hugh, it doesn't seem that extraordinary when we take into consideration the fact that we do currently have laws that allow for banks to use depositors' money to bail themselves in. The Dodd-Frank Act of 2010 allows for bank bail-ins. Of course, that followed government bailouts of banks after the financial crisis. So that's on the books. Dodd-Frank bail-ins are on the books. Is that something that you could see happening if the situation worsens?
Well, again, I think it's best to focus on the mechanics, like how could we evolve into the crisis? And again, we start from the fact that this is a Fed hiking cycle like none other. I mean, it's unprecedented that the entirety of the private sector in America has become immune, to the price of the existing mortgage stock and loan stock, But the problem you have is, let's say, good news, you get a new job, but you got to move state. You got to move from Texas to Florida. I don't know, I'm making it up, to New York, to whatever, California, God forbid, you got to move house. You need a new property. And so you need a new mortgage. And you go from paying like 2.5% to 7%. You're like, wow, that's hard. I mean, for the average American family today, were they to take on a mortgage to buy the median house and take on a new car loan, and so they would have to, if you will, pivot into the world of Federal Reserve being at 5.5%, plus, of course, the credit risk, okay, they're paying 7%. And that 7% swallows up 2/3 of their disposable income. Imagine that. Before your health insurance, before everything else in life, 2/3 of your money gone. So that's why things are likely to, I know they're great just now, but at the margin, the rate of change could accelerate to the downside. Okay. So the banks and being bailed in, and what we know, again, parallels. Okay. 2008 exposed like a really clever idea, which was that if you could put lots of mortgages together, that they would be less risky than government bonds. Okay, great idea. except it failed the test because the presumption was that nationwide house prices in America would never decline. Okay. When that was revealed to be a possibility, those assets, they blew up and it bankrupted the financial sector. Okay, so to your question, why would we need Dodd-Frank and a bail-in? We need a bail-in because 10-year treasuries today are over 4%, okay? The banks, there was another great idea from the government, from the Federal Reserve, said, hey, if you own government securities and you hold them to maturity, you can forget about them. You don't have to mark a gain or a loss in your income statement. Okay. Well, presently the unmarked loss is $500 billion. Okay. What is $500 billion? That is 2 times the book value of JP Morgan. That's a lot of money. Okay. And again, we can extend and pretend, but the more the depositors think, why have I got my money in a deposit account earning perhaps less than 1%, and they pull it, that puts pressure on truth to be revealed into the solvency of the sector. Now, presently, it's stabilized that the federal home loan banking organizations have pumped in over $100 billion of emergency aid. The trick just now is, like the little boy in Amsterdam, and he's putting his finger in the dike because there's a lot of water coming out. The federal home loans are like, yeah. But, okay, and the crux of the matter is a question of time, okay? I can extend, and I've extended, and I've pretended for 18 months, okay? But I'm a financial bank, I'm an insurance company, I'm a private equity company, I'm a pension fund. But I'm saying, come on, Federal Reserve, I need a pivot. I need interest rates now to come down. I need SOS or SAS, save my ass. But, now, the problem the Fed has is they're not inclined to cut. Most likely, they're going to wait and wait and wait because they're terrified of the comparison with Arthur Burns, who was an unfortunate or otherwise Federal Reserve president. I say unfortunate because I believe reputation is made by context. And Arthur Burns found himself, he hiked interest rates in the inflation of the 1970s, inflation fell, and he cut interest rates, only to discover to his great horror that prices were sticky and they went shooting back up. So history doesn't like Arthur, and J. Powell is determined not to be like Arthur. So I can assure you, the very last thing the Federal Reserve wants to do is cut rates. And so the more that time passes, then the greater the pressure to hide those financial losses in the system. And so we get to the point, 2008, the timing was very similar. We had Bear Stearns here for 80 years, gone in a morning, yeah? But by April, hey, folks, things were fine. They were stabilized. And then what happened? Wachovia, Washington Mutual, Countrywide. You see the boy, the finger is like, oh my God, the dam, the levee is breaching. Okay, so fast forward to 2023, we have several banks in March go, then nothing, and then as you correctly see, we've had a few tiny little institutions. We've had that Westpac merger, and then we've had the evidence from the Fitch and all the other rating agencies. It ain't getting better. Time is against the market. Time presently is against risk assets. That's the problem, time.
So as this pressure builds with a Fed that, as you say, is intent on staying higher for longer, or perhaps even staying where they are at for longer, do you anticipate those cracks in the wall, to use your metaphor there, starting to really break through and see even more bank collapses? Do you see more consolidation in the banking sector in the next year or so?
Well, consolidation only comes with insolvency.
That's the euphemism for it, yes.
Indeed. So again, I'd pull a little bit back from the screen, and I'd, because you made an excellent point that events that we would typically ascribe probabilities and say it's a 1 in 100-year occurrence, they're happening every 3 or 4 years. And it's like, hold on, life suddenly has become like super rapid. Okay, NASDAQ bubble at the beginning of the century, 2008, COVID, you name it. Yeah. Why is that? The reason is that at the margin, we are only able to exercise economic growth by having access to more and more debt. Okay, so there are 3 variables that control GDP growth: population growth, productivity growth, and debt growth. And population, nada. Productivity is a great mystery, but really isn't contributing. And so the economic growth of the last 15, 20 years has been dominated by an escalation in public debt and private debt, okay? And that is okay. The compromise for that is if you have 0 interest rates. I mean, if you're in ZIRP, your debt level can be anywhere, okay? It's the ultimate extend and pretend. But the Federal Reserve, now, I think it's mistaken. I think the parallel with the 1970s is mistaken because of the perilous and fearful community of global bankers today, that the credit that's necessary to be extended in order to accommodate higher and higher rates of change in wages and other prices, it's not there, okay? And when that disconnect reveals itself, we will be staring at a very sharp contraction in the economy. So my point to you is, it's the debt which has turned the global economy, I call it a volatility machine. I'm citing the work of others. Professor Michael Pettis wrote a book on this. The more that you introduce debt into any environment, the more the variability of the price series and the greater the uncertainty.
Okay, let's touch on this idea of a contraction in the economy, because that is also something that has not played out according to common wisdom, if you will. We were expecting a recession. We were expecting a market sell-off in the beginning of this year. At least many analysts were. Now talk of a recession has kind of flipped with increased chances of a soft landing. Goldman Sachs, for example, they have trimmed the estimated probability of a US recession over the next 12 months to 20% from 25%. As for a recession this year, JP Morgan doesn't see a recession at all in the third quarter. Bank of America also throwing in the towel on its recession call for the year, saying that incoming data has made them reassess their forecast. In fact, Bank of America is now seeing growth this year at 2%, followed by 0.7% in 2024. So mainstream banks, what is the contrarian's call on the likelihood of a recession, what it looks like, and when it could happen?
I mean, my retort to that is that on a hot, sunny day, let's say you've had the misfortune to have had a hike, not a misfortune, but the misfortune, you got a hole in your water bottle, yeah? And you've been walking in the baking hot sun for 2 hours, yeah? And you have a thirst. And someone gives you a cold can of Coca-Cola. Boy, does it deliver. I mean, when it comes to consumer brands, they do what it says on the tin, okay? I am not convinced that financial brands have the same power to deliver. I am not convinced that when you put the label, the almighty label of JP Morgan, Goldman Sachs, Morgan Stanley, and Bank of America, I'm not convinced that that actually provides any insight. All of the revisions in those estimates, I would argue, are very much a determinant of the fact that stock prices, and no more than 10 or 12 stock prices, prominent stock prices, have risen considerably this year. Yeah. And animal spirits feel better. When it comes to GDP forecasting, it's show business. It's made up. I won't give you probabilities. I'm going to tell you that it is way more complex I don't believe that anyone has the acumen to correctly forecast this. And I'm going to go one step further and reveal to those who don't know, the GDP statistics that we're looking at just now, right? When they get published, we get, the first estimate, the second estimate, the third estimate. We get the fourth, the fifth, the sixth, the seventh, the eighth, the ninth, the 10th, right? The UK economy apparently expanded 0.2% in the last quarter. 0.2%. So we measure growth in decimal points. It's all crazy. They don't know. And what you find, the history books tell you that whatever they thought, so when we look at Federal Reserve minutes, when they were trying to determine the optimal monetary policy in those frenetic months of 2008, the GDP statistics that they were using were all wrong. Within 3 years, they were significantly revised to show that the situation was much more alarming than the estimates were revealing, And again, think of the employment, the non-farm payrolls. Why is it that there seems to be a systematic bias, and then the revisions they're always revised lower, yeah. So all I'm saying to you, and I'll shut up, but we live and we have to speculate and invest in an environment where nobody knows.
All right, well, valid points about GDP being revised several times, not necessarily being an accurate reflection depending on the variables used. They tend to change. And also, if we look at GDP as a reflection of the health of the economy, well, it turns out that can also change, as we saw in 2022, when the Biden administration just changed the definition of a recession, no longer 2 quarters of negative growth. So that also changes if we go by GDP measures. All right, but still want to get your outlook on the economy, on the markets, on gold, and on Bitcoin, and on the dollar, and more. But we're going to have to take a quick break and resume our conversation in part 2. So stay tuned.
On the Spot with Michelle Makori is brought to you by Meld, the next-generation multi-chain crypto wallet that allows you to unlock the value of your crypto without liquidating your position. Undertake easy cross-chain transfers, yield, and borrowing by handling your crypto and fiat processes with transparency. Transfer fiat to and from crypto exchanges at low cost and in 15 currencies. Meld, your one account for money and crypto at your fingertips.